Should I buy Alibaba stock ticker BABA? That is the question many of us are asking ourselves here today, and in this video I'm going to be sharing my 5-part, more like 6 or 7-part analysis. First, an overview of Baba as a business and a look at their financials as a refresher and intro to the business. Of course, we have to talk about the risks involved because that's the biggest point of contention for Alibaba as an investment, such as regulation, delistings, and the Chinese market in general. Next is valuations and technical analysis. Did we find a bottom, and is it worth buying while it's trading at historical lows? Which leads us to fourth, the super investors who are investing in Alibaba, such as Charlie Munger and Monish Pabrai. And finally, fifth, my position, and of course, for full transparency, my plan and the trades I've made so far. My name is Matthew. If you're new here, welcome to the channel. If you're not, thanks for tuning in. Let's get into it. Jumping into part one here, we see that Alibaba is down over 26% since the start of 2021, and now trades at a market cap of $453 billion. If you didn't know anything about Baba, you'd think it was actually a pretty bad business based on this performance. However, that could not be further from the truth. Alibaba operates a very strong business model that takes advantage of network effects and owning an entire ecosystem, specifically their core commerce ecosystem. Baba's Taobao and Tmall marketplaces represent just one corner of the Alibaba ecosystem where consumers buy and sell goods. And guess who facilitates the buying and selling of goods? Alipay, also owned by Alibaba. And finally, the delivery of the packages is facilitated by ChenNow, a Chinese company launched by Alibaba in 2013 as a joint venture. So from the websites people are transacting on to the transactions themselves to the fulfillment of said transactions, Alibaba owns and has a hand in it all, and that is their core commerce ecosystem. It is what allowed them to fend off competition from eBay and even defeat Amazon's attempt in China. And as we know, very few can say they've stopped or dominated Amazon in anything. Not to mention their international expansion in commerce is also going strong, with retail up 54% and wholesale up 37%. Both make up small portions of overall revenue for now, leaving lots of room for growth. The jumps in international revenue here are largely attributable to both Lazada and AliExpress, with Lazada recording over 90% year-over-year order growth, a business focused in Southeast Asia. However, commerce is not all that Baba represents as a company. We can see in their most recent report that total commerce, the segment we just detailed, makes up about 87% of their revenue generated in their most recent quarter, Q2 of 2021. But acting as more of a conglomerate, Baba also operates and generates notable revenue from its emerging cloud business, 8%, and digital media and entertainment, 4%. And I want to focus a bit more on their cloud business before we move on to general tailwinds. And we still have to talk about their risks, fears, super investors, valuation, and so much more in this video. Alibaba's cloud was launched in 2009. We've seen success in the cloud from Amazon, a company often referred to as Baba's peer. From 2013 to 2020, Amazon Web Services, or AWS, went from $3 billion in revenue to over $45 billion in revenue, and now in 2021, over $52 billion in the past 12 months, making up 12% of Amazon's total revenue over that same period. AWS dwarfs Alibaba Cloud in terms of revenue, but studies still show that Baba's cloud initiative is 4th place in the global cloud marketplace, only behind Amazon, Microsoft, and Google. China's cloud market specifically reached $6 billion for Q1 of 2021, growing 55% year over year, and Baba remains solidly in 1st place in terms of Chinese market share. However, it does need to be careful, as Huawei made much stronger progress with 116% growth year over year, now gobbling up 20% market share. And this is from Q1 2021. Yes, Baba is double Huawei's size in terms of cloud market share for now, but Alibaba also just lost a top cloud customer in the internet industry, which resulted in this past quarter's slower cloud revenue growth. A year ago, cloud grew by 59% for Baba, and with this big customer lost, cloud grew by just 29% year over year for Q2 of 2021. On the bright side, Alibaba's cloud reported positive adjusted EBITDA, which is a measure of profitability. And this is even after they reclassified DingTalk to be included in the cloud computing segment, previously classified under the innovation initiatives. DingTalk is still a loss-making project, which means they contribute negatively to net income and profitability. Despite that, Alibaba could post positive adjusted EBITDA. There's no doubt that cloud is going to be massive for Alibaba in the future, but I have to remain objective and unbiased and remind you to keep an eye on Huawei as they are making progress and increasing in competition for that cloud market share. And lastly, I also want to mention that Baba does own 33% or 1/3 of a company called Ant Financial. So do keep that in mind, as some value Ant at 220 billion, others at 190 billion, and Fidelity recently valued it at 144 billion after regulatory crackdowns and a failed IPO. So to finish off their financials a bit here, they generated over 31 billion in USD for revenue for Q2 of 2021. That resulted in 6.6 billion USD in net income for this past quarter. So as a business, it is simply a cash cow. Now, adjusted EBITDA and net income did drop 8% year over year, and cash flow and free cash flow also dropped significantly. However, all of them were largely impacted by the anti-monopoly fine levied on Alibaba in April and investment in key strategic areas for the company. And for the fine, I believe about half was recognized and settled in Q2. Fundamentally speaking, this looks like a temporary setback on cash flow and free cash flow, as well as net income margins. They could be fined again in the future, but the business for now still looks healthy in my opinion. Now, zooming out onto a higher level, Baba has over 1 billion global annual active consumers, 912 million of which are located in China and 265 million are international. They have direct access to a multi-trillion-dollar market, with China set to overtake the United States as the largest economy in the world, and it could actually happen a few years sooner than anticipated, according to recent projections. China is also home to one of the fastest growing middle classes in the world, and it is well known that a strong middle class is the source of economic growth, as it provides a stable consumer base and a growing market for a company such as Alibaba. So that is an overview of the company and some of the bullish thesis for Baba. But of course, the question on everyone's mind is really the risks. Primarily, we're talking about the potential for delisting, VIE and ADR share structure, and also just simply being a Chinese company and the threat of swift regulation. This is where the video and argument for Baba might get a little bit more opinion-based, because after all, that's really what the stock market is people who think they're right on both sides of the trade for different reasons. But I'm going to try and keep it as facts-based as possible, and if you're one of the people who just wants absolutely nothing to do with China, and you're not even interested no matter what is going to be said, no need to watch further. This is for people who want to try and keep an open mind. So the first thing I'd like to point out is that every once in a while, the Chinese government will like to crack down or enforce new regulation and policies to show that it still has control over a lot of what's going on. And this happened in 2011, 2015, 2018, and usually after a few months, a lot of the Chinese stocks that suffered will bounce back and many times often reach new all-time highs. I think this is kind of what we're seeing again right here, where China is kind of flexing their muscle in terms of regulation. And I do believe, although it's gotten definitely more complicated today, history could repeat itself. All right, so first we'll talk about the potential for a delisting, and then we'll also talk about what you're actually buying when you buy ticker BABA on the New York Stock Exchange, and that's an ADR with a VIE structure. When you buy Baba, you're not actually buying shares of Alibaba, you're buying an ADR, or a certificate issued by a US depository bank that represents shares in Alibaba. In Alibaba's case, they represent a holding company in the Cayman Islands. In other words, yes, when you buy ticker BABA on the New York Stock Exchange, you don't actually own shares of Alibaba, the actual company over in China. And so if things were to get messy, it would get a little bit more messy for you. Now, one easy way to sidestep this risk is to simply purchase Baba on the Hong Kong exchange. And these are not ADRs, and this kind of eliminates this risk. You could buy Hong Kong shares via Fidelity or many other well-established brokerages, but those have to be in lots of 100 shares most of the time. If you're not willing to buy 100 shares at a time, or you cannot afford 100 shares of Baba, the next best option, in my opinion, is to simply adjust for your risk tolerance. Yes, the ADR risk is real, but if you're not afraid of it, then feel free to buy more. If you're convinced Baba will be delisted or VIEs and ADRs are too scary, then don't buy so much or don't buy any at all. No one is making you buy this stock. Personally, I think that 1, the VIE structure is simply too big to fail, and 2, if companies such as Baba were to become delisted, that would be a net negative for both the US and China. So to the first point, again, VIE share structure is a way for foreign companies, many in China, to list on US exchanges. And according to an article from December of 2020, Today, the 10 largest VIE stocks market value is around $2.3 trillion, and the US-based investors could hold as much as $7 billion worth of Chinese equities, mostly through VIE stocks. And these positions have vastly been underestimated and understated in the past because US official statistics did not treat Cayman Islands incorporated firms as Chinese. If we wipe out Alibaba and all the other VIE structured shares, we're wiping out a lot of US invested capital and market value in general. Furthermore, a delisting of major Chinese companies would probably significantly damage US-China relations, and do we really want to cause China to retaliate and start butting heads with what is soon to be the largest economy in the world, but also a major supplier of countless goods and services to the United States? This is all context that must be included with the delisting argument and the risks of ADRs and VIEs, because oftentimes when I hear these discussed, I only hear about the possibility of delistings and the risks of ADRs, but not the probability of those things actually happening. And there was legal action taken by the SEC. Even if Chinese stocks were to be delisted, specifically in relation to this new SEC law that was recently passed, it would require Baba to be non-compliant for 3 consecutive years before getting kicked off the New York Stock Exchange, which means this concern is at least 2 to 3 years out. So that's my take on the delisting, VIEs, and ADR share structure, and now let's talk about China in general. Again, a lot of fear and negative sentiment arose in 2011, 2015, 2018, and a few months later, many of the Chinese stocks made new all-time highs. Why or how? Well, I think this graph here does a pretty good job explaining why and how. In the short term, stock price is often driven by sentiment. It's a voting machine. However, over the long term, earnings and fundamentals drive stock price. It's a weighing machine. Right now, this is where I think we are. A lot of the fear around China has cratered Baba's stock price. But this is where we as investors also have to try and see through any short-term noise and trust that earnings will eventually override sentiment. And in regards to China as a whole, Ray Dalio, a famous investor and sort of a proponent for Chinese investments, made a great post last month where he tries to justify China's recent moves, restricting Didi's listing and data usage, and converting Chinese education companies into nonprofits, which ultimately did crater their stock price. He writes that they being Westerners, interpret moves like these as extremely anti-capitalist. However, over the last 40 years in China, it's shown a clear trend toward developing a market economy with capitalists becoming rich. As a result, many Westerners, according to Dalio, will miss out on what's going on in China. In the case of turning educational tutoring companies into nonprofits, they want to reduce educational inequality and financial burden on those who cannot afford educational assistance, because they, as in China, believe this is better for their country, even at the expense of shareholders. So the conversion of Chinese educational companies into nonprofits is definitely a bit terrifying, seeing as it, yes, again, cratered stock prices for those kinds of companies. But do you really think that they would do something that would crater the stock price of a company as large as Alibaba to zero? In fact, we saw recent regulation on Alibaba from the Chinese government with their anti-monopoly fine. And if you really analyze what happened, it looked like the government could have gone a lot harder on Alibaba, but instead they went with a lighter, more slap on the wrist kind of approach. So yes, Alibaba shareholders may have to deal with the occasional quarterly miss due to a one-time anti-monopoly fine or something of that sort, but will the Chinese government completely destroy Alibaba's business model and turn it into something like a nonprofit? My opinion, probably not. Charlie Munger also shares his perspective on China here.
The Chinese government will allow businesses to flourish. It was one of the most remarkable things that ever happened in the history of the world when a bunch of committed communists just looked at the prosperity of places like Singapore and said, the hell with this, we're not going to stay here in poverty, we're going to copy what works. And they changed communism. They just accepted Adam Smith and added it to their communism. They said, now we have communism with Chinese characteristics, which is China with a free market with a bunch of billionaires and so forth. And they made that shift. They deserve a lot of credit. Warren and I are not quite as good at that as changing our minds in many cases. and that was a remarkable change coming from such a place. And of course, it's worked like gangbusters. It had this enormous growth in the average income of the average Chinese. They've lifted 800 million people out of poverty fast. And there's never anything like it in the history of the world. So my hat is off to the Chinese. And I think they will continue to allow people to make money. They've learned it works. The Chinese, I love what the guy said in the first place. I don't care whether the cat is black and white as long as it catches mice. That's my kind of talk.
So all that is my take on some of the biggest risks facing Alibaba and the most discussed ones. Now I want to talk about the valuation and some technical analysis to see if we may have reached a bottom. Historically speaking, the price to sales ratio is at a 5-year low, and also historically speaking, their price to earnings ratio or PE ratio is at a 5-year low. Compared to its peers, Baba looks like even more of a steal with a 17x next 12-month PE ratio or forward PE multiple compared to Amazon's 62x forward PE multiple, a forward free cash flow multiple of 18x compared to Amazon's 43x. Now, I'm not saying that Alibaba should equal Amazon in terms of those valuation multiples, because there will always be a discount on Chinese stocks due to all the risks that we've outlined in this video. However, how much of a discount is too much? And if I try my hand here once again at technical analysis, this is the most recent peak at 319. We've dropped about 50% from its recent high, and here we are. This is today's price, and we can see a sharp decline here with a sharp increase in volume. Those gray bars in the back are volume, heavy volume, and a hammer right here, which is oftentimes a sign of capitulation. Is that sharp decrease, heavy volume, and that's a pretty nice candle. We also see that the MACD, which is a momentum indicator, is starting to cross over, and this right here is a support that dates back all the way to, let's see, this is 2018. So 2018, this line right here is a support that looks like it held yesterday. So I think maybe this 152 area was the bottom for Alibaba, but this is technical analysis and not my specialty. I am not specialized in short-term predictions for the stock market. I want to make that very clear, and this is all a guess. But I recently started buying back in and averaging down at about 162. Right now we're at about 174. And I started buying probably like right around here, maybe in the 230s, and I didn't buy anything. I waited, didn't buy anything on our way down because one, I didn't want Baba to take up too much of my portfolio, so I wanted a big drop to start averaging down, and two, I wanted signs of a reversal or capitulation like we see here. And I'm okay missing out on like a 10% run, 13% run if I don't hit the exact bottom, as long as I get a bit more confirmation that this could be the turning point. So hopefully we're correct here and the bottom may be in for Alibaba. And again, every trade I make is posted in real time to investor community. You can check that out in the description below. So the valuation, business model, and the incredible amount of fear surrounding the stock right now is probably why there are so many super investors investing in Alibaba. The famous, overly used Buffett quote that everyone recites but few truly live by, "Be greedy when others are fearful." And right now, there is plenty of fear. Charlie Munger, Warren Buffett's longtime investing partner and super value investor, is also largely invested in Alibaba. I already showed you a video of his thoughts on China, and you can see his position here alongside other super investors who have been trading on Baba. Above Munger is Mohnish Pabrai, who recently increased his position by 53%. Pabrai is a legendary investor who compounded at 25.7% over 18 years, which is an incredible feat. He holds an extremely concentrated portfolio, with Baba being one of just 3 holdings. Granted, it's his smallest position in this portfolio. He has been selling Micron and Seritage and buying Baba since the start of 2021. And lastly, we want to talk about my position in Alibaba. This is for full transparency and just so you guys know what I'm up to. As of now, Alibaba does make up just less than 5% of my portfolio. Again, as I showed you just now in the chart, I started buying around the 230s, and then I started averaging down again in the low 160s. And if it stays in the 160s for a while, I may continue to add more. If it drops further, I will definitely add more. If it continues to run up, I may just add a teensy bit more. So I'm planning to add just a little bit more. It just depends how much more I add. And if it stays in the 160s or 150s for a long time or consolidates around here, I may consider making it even more than 5% of my portfolio, closer to 7%. At the end of the day, I really think it's just about risk tolerance. If you don't trust Chinese companies, you think all the risks are going to come true and be realized, then you can put 0% of your portfolio into it. If you think you're not really sure, then maybe like 2 to 5% if you want. And if you fully trust Chinese companies, you think the risks are overblown and it's going to be a home run stock, then put, I don't know, 20, 50, 100% of your portfolio into it if you want. And again, for my research, real-time buys and sells, 24/7 access to my portfolio, and of course, weekly live mentor sessions from our mentors who are in the finance industry, you can check out Investor Community down in the description below. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace, and thank yous.